In 80 years, a new chairman of the Federal Reserve has almost never had to walk into meetings knowing the man he just replaced was still sitting 2 seats down the table. That's happening right now. Kevin Warsh was sworn in this year as the new chairman of the Federal Reserve, replacing Jerome Powell. In a break with nearly every precedent in the Fed's modern history, Powell didn't leave the building. He stayed on the board of governors in the room for the remainder of the term that runs 2 more years. That's strange enough on its own. But here's what most coverage compressed into a single sentence, and what I want to actually unpack. Warsh got this job in the middle of a genuine criminal investigation into the institution he now runs. An investigation that got dropped at almost the exact moment his confirmation needed to move forward. And the president who fought harder than any president in modern history to install him still hasn't gotten the one thing he wanted most. By the end of this video, you'll understand what actually happened behind that confirmation vote, what Kevin Warsh has said, in his own words, about how he sees the Fed's job, and why the gap between what he was put there to do and what he's actually doing might be the financial story nobody's fully connecting right now. Let's start with who this man is, because his background matters more than almost any Fed chair in recent memory. Kevin Warsh is 56. He's not new to the Fed. He served as a governor from 2006 to 2011, one of the youngest people ever appointed to that board. That means he was inside the Federal Reserve during the 2008 financial crisis, helping shape the response to the worst banking collapse in generations. After leaving in 2011, he became a partner at Duquesne Family Office, the private investment firm run by legendary hedge fund manager Stanley Druckenmiller, and took a fellowship at Stanford's Hoover Institution. For over a decade, Kevin Warsh has been living on the other side of the table from where he now sits, inside private capital and market speculation, watching the Fed's decisions from the perspective of someone whose job was to profit from predicting them. That's not a scandal. Plenty of former Fed officials move into finance. But it's context worth having, because it shapes how someone sees the world. And we're about to get to exactly what Warsh has said about that world in his own words. Before we do, it's worth remembering that this isn't the first time a Fed chair has taken the job in the middle of open political pressure from the White House. In the early 1970s, President Richard Nixon spent years pushing Fed Chairman Arthur Burns, a man he'd personally appointed, to keep interest rates low heading into the 1972 election. Nixon reportedly leaked stories to the press suggesting Burns wanted a pay raise, applied private pressure directly, and got what he wanted. Burns kept policy loose. Nixon won re-election in a landslide. And the inflation that loose policy helped unleash didn't show up on election day. It showed up over the rest of that decade, in the double-digit inflation of the mid to late 1970s that took nearly a decade, and a brutally painful recession under a later Fed chair, Paul Volcker, to finally break. That's the actual historical precedent economists reach for when they talk about political pressure on central banks. Not a hypothetical, not a scare tactic, but a documented case where short-term political convenience and long-term monetary stability turned out to be direct trade-offs. Keep that case in your back pocket, because we're going to come back to it. Here's where the Warsh story gets genuinely interesting. Throughout his years away from the Fed, Warsh became one of its most persistent public critics. Last year, in a televised interview, he called for what he described as regime change at the central bank. Not a policy adjustment. Regime change, a phrase usually reserved for describing the overthrow of governments, aimed at the very institution he was about to be nominated to lead. President Trump had spent years publicly attacking then Chairman Powell for keeping rates too high, wanting them lower, and making no secret of his frustration. When Powell's term approached its end, Trump nominated Warsh, a known vocal critic of the exact policies Trump was frustrated by, to take his place. Here's the part that barely made a ripple outside financial media, but should have made a much bigger one. Warsh's confirmation was delayed for months, in part because of a broader pressure campaign the administration was waging against the Fed, a campaign that, at one point, included the Department of Justice opening an actual criminal investigation into the central bank, tied to renovation costs at its headquarters. One Republican senator, Tom Tillis, initially blocked the confirmation from even reaching a committee vote, specifically to protest that investigation. Tillis only dropped his opposition after a U.S. attorney agreed to drop the probe. Read that sequence again. The sitting president's Department of Justice opened a criminal investigation into the Federal Reserve. That investigation became a bargaining chip in getting a senator to allow a vote on the president's own nominee to lead that same institution. Once the political deal was struck, the investigation disappeared, and the confirmation vote happened. That's not speculation. It's reported on the record by NPR and multiple outlets covering the confirmation. It's simply a sequence most people never saw laid out end to end behind the headline, "Warsh confirmed as Fed chair." The final vote was 54 to 45, the most divisive confirmation for a Fed chair in the modern history of the institution, breaking down almost entirely along party lines, with a single Democrat, Pennsylvania's John Fetterman, crossing over to support him. For an institution that has spent a century trying to project itself as above politics, that vote alone tells you something has shifted. Now let's get to the part of this story that's actually, literally, about something Kevin Warsh is not telling you. Because it isn't a metaphor in this case. It's a direct quote from his own confirmation hearing. During that hearing, Senator Elizabeth Warren asked Warsh a very specific question. Who gave him a reported $100 million just days before he was sworn in? Warsh declined to identify the source. He said only that he'd comply with the disclosure rules set by the Office of Government Ethics. When Warren pressed him again, directly, on whether he would disclose how he was divesting those assets, he gave the same non-answer. Warren called that refusal a serious conflict of interest concern for the country's most powerful financial institution, and at one point described him, on the record, as a sock puppet for the president who nominated him. Here's why that $100 million question isn't just political theater. Warren also used the hearing to raise a second issue, whether Warsh's leadership could end up benefiting a Trump family business venture in crypto called World Liberty Financial, which generated roughly $1.4 billion in 2025 and was, at the time, seeking a U.S. bank charter. If that charter is approved, the company could eventually seek access to the Fed's own payment system through what's called a master account, direct plumbing into the central bank itself. Unlike his predecessor, Jerome Powell, Warsh has been publicly supportive of digital assets. Whether those two facts connect to anything specific is genuinely unclear. But it's exactly the kind of unclear that a sitting Fed chair who took over an institution built on public trust in its independence is supposed to resolve with transparency rather than a declined comment. And this isn't a one-time story that faded after the confirmation hearing. Just this month, in mandatory testimony before the Senate Banking Committee, Warren was back, this time pressing Warsh on an entirely different transparency question, whether he had even asked one of his own Fed colleagues, Vice Chair for Supervision Michelle Bowman, about her attendance at a dinner hosted by Bank of America that may have violated the Fed's own internal rules. The Fed enforces something called a blackout period around every policy meeting specifically to stop officials from talking to bankers and markets in ways that could look like an information edge for insiders. Warsh wouldn't say whether he'd even raised the question with her directly, deferring instead to an ongoing investigation by the Fed's independent inspector general. Warren's response, on the record, was that the tone he was setting seems to invite corruption. That's not a metaphorical secret. That's an actual, specific, on-the-record refusal to answer actual, specific questions about where a 9-figure sum of money came from and about whether the Fed's own ethics rules are being enforced on his own watch. You can draw your own conclusion about what that refusal means, but it should be part of how you evaluate everything else this video covers, because a Fed chair who won't answer a direct question about $100 million is not exactly modeling the transparency the institution depends on for public trust. Now here's the second tension I promised, where what Trump wanted and what's actually happening start to pull apart. Trump nominated Warsh expecting lower interest rates. Powell was too restrictive, in Trump's words, and Warsh, the man who'd called for regime change, was supposed to be the fix. Here's what's actually happened since Warsh took the chair. Rates haven't come down. As of the most recent data, analysts describe it as close to a coin flip whether the Fed's next move is even a cut at all rather than a hike, because inflation data since Warsh took over has been stickier than the pressure campaign accounted for. The president, who fought a multi-year battle, including pressuring the Justice Department to install someone he expected to deliver lower rates, has so far not gotten lower rates. It's worth knowing exactly how explicit Trump has been about what he wants, because it isn't subtle. In one social media post before Warsh's nomination, Trump said he wanted a Fed chair who would cut interest rates specifically when the stock market rose, which is close to the opposite of what traditional economics would actually prescribe, since a rising stock market is typically a sign the economy needs less stimulus, not more. In that same post, Trump added a warning. Anyone who disagreed with him would never be the Fed chairman. Around the same period, Trump also attempted to fire sitting Fed Governor Lisa Cook, an unprecedented move toward a sitting central bank official that added to the broader sense that the traditional wall between the White House and the Fed was being tested on multiple fronts at once, not just through the Warsh nomination. Kevin Hassett, director of the White House's National Economic Council, went on television shortly after Warsh's confirmation and said markets were relieved because Warsh would help lower interest rates over time, while, in the same breath, insisting he wasn't personally putting any pressure on Warsh at all. Warsh himself, under direct questioning at his hearing, denied that Trump had pressured him to cut rates and stated plainly that he intended to be an independent actor if confirmed. Believe whichever version of that story you find more convincing, but the fact that it needed saying twice by two different people tells you the question was live enough to require an answer. Why haven't rates actually come down yet, given all of that pressure? Because monetary policy doesn't respond to who sits in the chairman's seat. It responds to actual economic conditions: energy prices, consumer demand, wage growth, supply constraints. A Fed chair who arrived with a reputation as a rate cut messenger is now navigating the same stubborn inflation numbers that made Powell cautious in the first place. Whether that's coincidence or vindication for Powell's caution is genuinely up for debate among economists who disagree on almost everything else. Let's talk about what Warsh has actually done since taking the chair, because it tells you more than any campaign season soundbite. His first major move was announcing a broad-ranging review of how the Fed operates and communicates, essentially an audit of its own habits. Early reporting suggests he wants the Fed to be less involved in forward guidance, publicly signaling its future intentions to steer markets ahead of time, and to lean more on incoming private sector data before committing to a direction. That sounds like a technical style preference, but think about what it means practically. For years, markets have priced in decisions partly based on what the Fed signals is coming. A chair who pulls back on that signaling makes the future genuinely harder to predict. For everyone, not just insiders. Less guidance from the most influential financial institution on earth means more uncertainty baked into every rate-sensitive decision in the economy, from corporate borrowing to your own next mortgage refinance. Here's the balanced way to think about the actual controversy, because this is a topic where informed people genuinely land in different places. One view, held by serious economists: a president pressuring the Fed tied to a criminal investigation that conveniently disappeared once the political goal was achieved, represents a real erosion of central bank independence. Independence that exists specifically so monetary policy doesn't bend to whoever's currently popular, since that's historically how countries end up with runaway inflation. The other view, also held by serious people: the Fed is a government institution, not a branch of government immune to oversight, and a president pushing for policies through the entirely legal nomination process the Constitution provides is simply democratic accountability at work, even when the process gets ugly. I won't tell you which one is right. That's a genuine values question about how independent an unelected institution controlling the money supply should be from elected officials. But whichever side you land on, Fed independence isn't a minor technical detail. It's one of the core reasons U.S. Treasury debt is trusted by the entire world. Investors buy it partly because they believe the Fed will fight inflation even when it's politically inconvenient. If that trust erodes, that's not an abstract argument. It has real consequences for how much it costs the government to borrow, how the dollar is valued globally, and how the inflation you feel at the grocery store behaves for years afterward. Remember Arthur Burns from earlier in this video. The lesson from that era wasn't that political pressure on a central bank produces instant visible damage. It produces damage that shows up late, years after the political benefit has already been collected, after the president who wanted the favor is long out of office, and after the person left holding the consequences is an entirely different Fed chair, dealing with an entirely different, angrier public. If there's a version of that pattern playing out again here, nobody will be able to prove it in real time. That's exactly what makes it worth watching now, while the actual decisions are still being made, rather than trying to explain it after the fact. So here's what to actually watch for, instead of a made-up prediction with a date attached. Watch whether Warsh's Fed cuts rates in coming meetings, and how closely that timing lines up with political pressure versus actual inflation data cooling off. If cuts happen as inflation genuinely improves, that's the Fed doing its job. If cuts happen while inflation stays elevated, that's the exact scenario independence-minded economists have been warning about. Watch how the bond market reacts. Foreign and domestic buyers of Treasury debt are watching Warsh's Fed as closely as you are. If doubts emerge about whether decisions are data-driven or loyalty-driven, it will show up first in Treasury auction demand. And watch whether the broad-ranging review of the Fed's operations turns into genuine reform or into a justification for less transparency about how decisions get made. Two very different outcomes wearing the same headline. There's a fourth thing worth watching too, and it's the quietest one: who Warsh appoints and promotes underneath him. A Fed chair doesn't set policy alone. The Federal Open Market Committee votes, and it's made up of Fed governors and regional bank presidents with their own independent views. If the people rising through that committee over the next couple of years increasingly share Warsh's, and by extension Trump's, preference for lower rates regardless of inflation data, that's a much more durable form of influence than any single rate decision, because personnel outlasts any one news cycle. Committee composition rarely makes headlines the way a rate decision does, but it's arguably the more important signal for where policy is actually headed 3 or 4 years out. Here's why the crypto question in particular deserves more attention than a single hearing exchange gave it. A master account at the Federal Reserve isn't a minor banking convenience. It's direct access to the country's core payment infrastructure, the kind of access that lets an institution move money at the speed and trust level of the government itself without going through an intermediary bank. If a business tied to a sitting president's family were to gain that kind of direct pipeline into the Fed under a chairman who has been personally supportive of the asset class that business operates in, that's not a hypothetical conflict of interest. That's the textbook definition of one. Nobody has proven wrongdoing here, but nobody has proven it yet is exactly the phrase attached to every financial scandal in the early stages, before anyone had gathered enough to prove anything at all. Here's what I want you to leave this video understanding, because it's more useful than a villain narrative. Kevin Warsh isn't a mystery man with a secret plan hidden in the shadows. In some ways, he's the opposite, a known quantity, a former Fed insider turned outspoken critic, appointed through an unusually political process, who has now, on the public record, twice declined to answer direct questions about where a 9-figure sum of money came from, and whether his own institution's rules are being enforced on his watch. That's not speculation about a hidden agenda. That's a documented pattern of non-disclosure from a man now running the most important financial institution on earth, while the president who installed him watches for a result inflation data hasn't allowed yet. Whether that tension resolves toward independence or toward political and financial pressure isn't something I can predict with certainty, and I'd be lying to you if I told you I could put a date on it. What I can tell you is that every piece of it, the confirmation vote, the dropped investigation, the undisclosed payment, the crypto ties, the Bowman question, is already sitting in the public record, reported by outlets across the political spectrum, for anyone willing to actually read past the headline. Most people never do. That's not because the information is hidden. It's because it's scattered across a dozen different stories that never get assembled into one place, so the pattern never quite becomes visible. That's the whole point of a channel like this. Not guessing what happens next, but understanding the mechanism well enough to see it happening in real time, and assembling the scattered pieces into a pattern before the next headline drops. If this helped you follow a story, most coverage leaves in disconnected fragments, subscribe. We're going to keep tracking exactly how this plays out, starting with the next rate decision, the resolution of the Bowman Inspector General inquiry, and whether either one lines up with the data or with the pressure.